The Morgan Report with David Morgan.
David Morgan, themorganreport.com, weekly perspective for the week ending 13 August 2021. Well, I thought I'd do something a little different. This is the 50-year anniversary of Richard M. Nixon closing the gold window and reneging basically on the contract that was set forth in the Bretton Woods Agreement. And here is Richard M. Nixon. Of course, some refer to him as Tricky Dicky, and this is his prepared speech he gave. It's only 1 minute and 18 seconds long.
The third indispensable element in building the new prosperity is closely related to creating new jobs and halting inflation. We must protect the position of the American dollar as a pillar of monetary stability around the world. In the past 7 years, there's been an average of one international monetary crisis every year. Now, who gains from these crises? Not the working man, not the investor, not the real producers of wealth. The gainers are the international money speculators. Because they thrive on crises, they help to create them. In recent weeks, the speculators have been waging an all-out war on the American dollar. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. Now, this action will not win us any friends among the international money traders. But our primary concern is with the American workers and with fair competition around the world. To our friends abroad, including the many responsible members of the international banking community who are dedicated to stability in the flow of trade, I give this assurance. The United States has always been and will continue to be a forward-looking and trustworthy trading partner. In full cooperation with the International Monetary Fund and those who trade with us, we will press for the necessary reforms to set up an urgently needed new international monetary system. Stability and equal treatment is in everybody's best interest. I am determined that the American dollar must never again be a hostage in the hands of international speculators. I'm taking one further step to protect the dollar, to improve our balance of payments, and to increase jobs for Americans. As a temporary measure, I am today imposing an additional tax of 10% on goods imported into the United States. This is a better solution for international trade than direct controls on the amount of imports. This import tax is a temporary action. It isn't directed against any other country. It's an action to make certain that American products will not be at a disadvantage because of unfair exchange rates. When the unfair treatment is ended, the import tax will end as well. As a result of these actions, the product of American labor will be more competitive, and the unfair edge that some of our foreign competition has will be removed. This is a major reason why our trade balance has eroded over the past 15 years.
Basically blames the speculators, not that the U.S. government basically reneged on the contract they had with the world as far as keeping the dollar as good as gold. It was until enough people called their bluff. Another good place to get a little bit of background for those that don't or want to refresh their memories is actually, this is right off of the Federal Reserve. It's federalreservehistory.org. Nixon ends convertibility of U.S. dollars to gold and announces wage and price controls. Remember, inflation was all the way up to 5% back then, and they were very worried about that outrageous amount of inflation, and Nixon set in wage and price controls due to the fear of inflation getting out of hand. So it's a pretty good article here. Shortly after the plan was implemented, the growth of employment and production in the United States increased. Inflation was practically halted during a 90-day wage and price freeze, but would soon reappear as the monetary momentum in support of inflation had already begun. Nixon's new economic policy represented a coordinated attack on the simultaneous problems of unemployment, inflation, and disequilibrium in the balance of payments. The plan was one of many prescriptions written to cure inflation, which would eventually continue to rise. You might heed those words for where we are now and observe what happens in the future. So I couldn't find an exact chart. This is a pretty good one showing from the 1971 point here, using that as your basis when we went off the gold standard, to 2017, obviously, it doesn't go to 2021, that we've seen the dollar's value, purchasing power, continue down. I think it's probably a little worse than this shows. Of course, we're out, another 4 years here, but you get the idea. I think one of the most important things to look at, of course, is the M1 money supply, and take a look at this chart. It's gone straight up. And of course, M1 is composed of physical currency and coin, demand deposits, checkbooks, and other negotiable withdrawal type of accounts. In other words, it's the most liquid portion of the money supply because it's the currency, coins again, that can be quickly converted to cash or cash itself. I'm going to go ahead and make this a short video, but I did an interview with Craig Hemke, TF Metals, James Anderson, SD Bullion, Jim from Wall Street Silver, Lee from Wall Street Silver, and yours truly. And we talked about this 50-year anniversary, so if you're so inclined, you might want to check that out. I'm sure you can find it on Twitter under the Wall Street Silver account, and once it's posted, I'll retweet it. But this is an article from the New York Times, and this is 10 years after Nixon closed the gold window, and this is a pretty interesting article. I'll just highlight some of it. Should we or could we return to gold standard? And of course, it's typical, in my opinion, that a lot of the mainstreams really likes to bash gold. So it starts off here. Washington Kings called it a barbarous relic. Lenin said it was only fit to adorn lavatories of the world. 10 years ago, Nixon, in effect, tore the world's currencies loose from it, putting the dollar away from the gold peg. Still, gold has lost neither its romantic allure nor its practical attraction. So they go through and talk a little bit on the positive side. It's a fairly objective article. I wouldn't call it totally objective. There's a lot of Q&As here, and of course you can look up this article. It's pretty easy to find, but it's kind of interesting, some of these answers. Here's one about talking about savings, and, of course, always the big bash on gold is it doesn't pay any interest at all. So the only benefit to savings, it's called savings in gold, I see, is that people would have more confidence in the currency, and for that reason might save more. But I don't believe that in the days of the gold standard, savings was higher than it is today. So this is very interesting, going back only 10 years from the close of the gold window and seeing what was written. And then you can take that in context of 40 years further, which is where we are now, and realizing the massive amount of inflation that's taken place in the currency. Among all currencies, the U.S. not being the most, not being the best in a way as far as depreciating a currency at a lower rate than many other nation states. What do you think would be the role of gold today in the international currency system? To serve as kind of a last-ditch source of liquidity. Countries that lack foreign exchange are not sure they can also earn or borrow foreign exchange if they have a gold supply, would be able to borrow against it. Several countries did that during the 70s. Some countries sold off their gold, including the United States. The severe shortages and booms of the last 19th century had great economic consequences. The consequences were all very beneficial. From 1875 until about 1912, the average rate of variation of the price level never exceeded 2%. Compare that to the last 10 years with a manipulated paper currency system where price levels have varied as much as 13% above the previous year several times. So actually they're making a case here about, stability and instability. And of course, on a paper standard, it's more unstable. I think I'll end with this one. This is from Forbes. And of course, Steve Forbes is pretty much a conservative fiscally and monetarily, at least relatively speaking, a lot of money magazines. So this is gold standard ended 50 years ago. Federal debt has only exploded since, and Frank Holmes has contributed. Frank and I are, know each other fairly well. All right, this year marks the 50th anniversary of the end of the gold standard in August 1971, and Nixon formally unpegged the dollar from gold. And yet still restrictions on private ownership of gold coins, bars, and the like. There were still restrictions back then. Of course, in 74, he said, okay, Americans can own gold. And then, of course, it talks about the age of runaway debt. The drawback is in the years since the end of the gold standard has been significant and growing lack of discipline when it comes to government spending. Before 1971, there was a natural limit to how much money could be printed. Of course, that's really true in theory, but really not what happened, because what happened was the U.S. printed a lot more dollars than there was gold available to back those dollars at $35 per ounce. And France and others, especially France, called the bluff on the United States, and that's really the reason that Nixon closed the gold window. It wasn't because of the speculators. It was because the fiscal responsibility of the United States was in question because they weren't really adhering to the contract they made with the rest of the world. That's the truth of the matter. To give you some idea of how dramatically times have changed, the federal debt in 1960 was only a little over half the size of the economy. The debt is expected to surge even more in the coming months now that Joe Biden has been sworn in as president. Biden, who turned 78 in November, has called for a $1.9 trillion economic relief package that includes the $1,400 checks. Of course, that's kind of past history. The rise of modern money theory. I think most of you who listen to my podcast know what that is. If not, you can look it up. Our favorite way to get exposure to gold. Ray Dalio, billionaire founder of Bridgewater, the world's biggest hedge fund, has said a number of times, cash is trash. Our favorite way to get exposure to gold. So where does Dalio put money instead? A look at Bridgewater's third quarter filings reveal large portions in physical gold and gold mining companies. At 11.6, the gold-backed Spider Gold Trust is the fund's second largest position. The fifth largest position is a 3.4% in the iShares Gold Trust. Strong track records resulted in companies consistently returning value to shareholders. Talking about some of these. Franco, one of the ones that we have in the Morgan Report consistently, talks about ending on these companies. And, of course, this was pretty much written by Frank. Frank's a big proponent of Franco, as well as myself. So I said I would end on the Forbes article, but I'm not going to end on this one. This is McIlvaney's weekly commentary from David McIlvaney. And I'm old enough to know his father, Don, and David was, I think he was like 10 years old when I met him at a gold conference that many years ago. Anyway, regardless, he's every bit as good as his father, in my opinion, probably even better. This is something you might want to listen to. He has great commentaries, and this one on 50 years of freedom from the nasty gold standard, I think, is a good way to round out this 50-year anniversary from the departure from President Nixon into the gold standard. You can also read it or listen to the podcast, as you can see. So I'll leave it there. This is David Morgan of themorganreport.com. I'll be back with you next week with another weekly perspective.